E. coli outbreaks aside, I think it's fair to say that there has recently been a rash of hyperbolic warnings of fear and impending market and economic doom. Simply put, the bad news bears are out in force. Now, sure, yes, we have had bad economic reports lately. We get the big jobs number tomorrow. We'll wait and see what happens there. I get all that. And yes, stocks have sold off a bit from their recent highs. But is all of this sort of chicken little-ish sky is falling stuff gone too far? In other words, are the panic-peddling prognosticators on the money, or are they totally missing the mark? Joining us is Kim Cauley-Forrest, Senior Equity Analyst at Fort Pitt Capital, Tommy Belesis, Founder and CEO of John Thomas Financial, and Jim LeCamp, Portfolio Manager of Macro Portfolio Advisors. All right, no Kim yet. I was going to go to her because, you know, ladies first when I'm warm in the chair, but she's not there yet. So we're going to start off. Tommy, you're next to me. We'll begin with you. Sure. Has the doom and gloom simply gone too far? And yes, we'll throw the media, us,
right
in with that.
You know, Brian, I think the media has gone too far. You know, when the market pulls back, they over-exaggerate what's going on in the market. Sure, we've had a couple of bad days, but that's not room and cause for panic. People should be watching the market and the attractive valuations in stocks and understanding that this is not 2007 and 2008. Households, corporations are in a much better financial position, so people should be looking at this opportunity on a pullback and be buying great companies on a pullback.
The XLF financial sector ETF has lost 10% in just 4 months. The financials are rolling over. The financials have tended to lead where we go overall.
Yeah, Brian, great point. Unfortunately, I think there's a vacuum of good news out there because earnings season ended. So there's nothing to balance out the negativity. So what are people doing? They're generating cash. That's a good thing because you know what's going to happen? As soon as the good news comes out with earnings over the next 30 days, people are going to start putting that cash to work.
Jim LeCamp, I have a feeling you are not going to balance out the negativity.
Well, I think the concerns are justified. No, this is not the end of the world. It may be the end of the Keynesian world, but it's not the end of the world. Look, these concerns are justified. We've seen the biggest set of economic disappointments that we've seen since the start of the Great Recession. Global purchasing managing indexes are rolling over. Quantitative QE2 is ending now, and at the end of QE1, we had a 15% correction in the market. And I think what's happened here is every time we've had a little bit of a pullback, while QE1 or 2 was going on, it was just a 2 or 3% pullback. Investors got very complacent and started buying every little tiny dip. But 10% corrections are normal on Wall Street, just not during QE. But QE's ending, and there's a growing concern that the Fed is out of bullets, that there won't be any QE3. And so I think investors should be very, very careful in here and not overly aggressive and not buy every 200 or 300 point dip.
Why, Kim Cauley, shed some balance on this, all right? Because you and I have talked for a long time, and with all due respect to Fort Pitt's customers and everybody else out there, retail investors tend to do the wrong thing. If you bought the March 09 lows, you made a nice piece of coin. Should we buy on any dips?
Well, I think you need to look at individual names and, you know, assess that. I don't like assessing the whole market and trying to buy, you know, a basket of the market. Instead, we look at individual names. And the other thing to consider is we are not traders. We buy good companies. So we keep these stocks for a minimum of 3 to 5 years. So if I'm looking out 3 to 5 years, I'm thinking that time period's probably going to be better than what we're going through right now. So you buy quality companies, and you know, you ride through this storm.
What if you're 2 or 3 years away from retirement, right? Would that be too risky? If you're 10 or 20, that's one thing. You can ride out the dips. What if you're just a year, 2, 3 years away from retirement? Should you still own any equities, given the uncertainty?
It depends on your individual situation. It depends on how much cash flow you're going to need in 3 to 5 years. That's the thing. We have, you know, older clients in their 80s that are heavily weighted in equities, and it's because they have sufficient cash flow from some other means. So age is not the determinant of your financial condition, or you know, where your money should be.
Look, I want to make a point here.
Let's let Jim go. Tommy, we'll get to you. Go ahead, Jim.
There's a lot of people that are buy and hold type investors that come on these shows, and they say if you would have bought March of 2009 lows. Look, if you're buy and hold,
not one of the buy and hold investors. That's me.
I'm not saying Kim said it. Hold on. I'm not saying Kim said it. I'm saying there's a lot of people that come on this show and say that. that. The fact is, though, if you're a buy and hold investor, you didn't have any cash in March of 2009. You were way down. You had no money to spend.
The Dow didn't go to zero, and all your losses were on paper unless you sold at the bottom.
Brian,
if you wait and you have cash on the sidelines, you can take advantage of dips. If you're fully invested all the times, you have no bullets in your gun, and you can't take advantage of dips.
Brian,
and we always have some cash, and that's important. I think that's really, really important, not only for cash flow.
And not to forget, there's approximately,
I need some support here on set.
We can't forget there's approximately $14.2 trillion in cash overseas, $8.2 trillion here domestically. Plus, you have the Fed on our side, and you can't fight the Fed. So to say, that we're in a doom and gloom phase, and let me say this: in March we were at 11.8. The Dow ran to 12.8, almost 13,000. We're in the same position now. Once good news starts coming out, we'll be back at 13,000.
And Jim, I don't think anybody, especially myself, is trying to be a Pollyanna about this. We got a lot of problems with the economy. Housing stinks. The job market still hasn't moved. We got government over-involving itself in the capitalist system and causing a whole mess of pain. I'm starting to sound like Kudlow. It's only my third day on the show. That aside, if the Dow isn't higher in 10 years, it means we're probably living in a cave and, with a flint stick anyway, because something else happened.
No, that's not the way to look at it. That is not the way to look at it. Look, the Dow in 1998 and 1999 was about where it is now. We haven't made that much progress. Buying and holding, in fact, the NASDAQ is well below where it was in 1999. Yes, if you wait forever, if you have 20-year time frames like we had from 1900 to 1920, from 29 to 46, from 66 to 82, and from 99 to now, you go through long periods of time where the market's all over the place but doesn't go anywhere. I think you have to be more nimble than that and have some cash.
How nimble
from time
is nimble?
to time.
Because the market did double from 74 to 76. The S&P did double in a 2-year period.
That's right. And if you were in and out, it was fine. But if you waited from 66 to 82,
we're not
66 to 82 is 16 years. It was at 1,066 and it was 1,082. That's no progress.
Yeah, just to add to that, though, and I disagree. Let me tell you why. We heard the same doom and gloom at Dow 10,000. Where did we go? 11,000. Then we heard the same thing at 11,000, and now we're at 12.2. We're at 12.8. So I think at the end of the day, if you position yourself correctly, you will make money in this market.
I agree. I think you have to be more
ladies
nimble.
first, the first word to Kim, but I will give you, Kim, the last word.
Thank you. I think buy and hold is a misnomer. This is more of a portfolio approach. Some stocks are in, some stocks are out. What we're really talking about here is being able to buy and sell quality stocks and not market time. If you can market time, God bless you. I don't know that anybody can reliably over their investing lifetime. So what you have to do is decide you're going to hold equities, boot out the ones that are, at what you would consider full valuation, buy ones that are under, and that's how you win. But you have to be in equities, because what are your other asset classes? Real estate, not going anywhere. Bonds, probably not a great buy right now. So it looks like equities are your asset class for appreciation.
Or you buy a struggling National League baseball team that is not the Pirates.
But you don't have to be in all the time. You do not have to do that.
Hey,
fair enough. Kim?
The Pirates don't win, but they make money.
That's great, because they're subsidized by the Yankees, Kim.
Let's just hope the Mavericks win tonight.
Tommy, there you go. I agree with that. Kim, Tommy, and Jim LeCamp, great conversation, everybody. Thank you very much.
Thank you.
Coming up, Goldman Sachs getting some heat, more heat. It is now apparently on the receiving end of a subpoena. Is the vampire squid squishable?